We detected an unusual trade worth $1 million on Robinhood stock, ticker symbol HOOD. But here's what makes it more interesting. Robinhood stock has dropped about 40% from its high in just a month. Now keep in mind, if you've been following our channel, you know that our previous options trade on Robinhood expired last month with a 500% profit. This was the video we posted back then where we showed exactly how that trade made 500% profit. If you missed it and want to see how we made that much by tracking the trades of wealthy investors, we'll put a link to this video at the top. Make sure to subscribe and hit the bell icon so you don't miss out on these very profitable opportunities. Now, notice how we exited our long bullish trade around this price level here. Since then, Robinhood stock has not gone much higher. It's actually still trading lower than where we closed out our position. So in hindsight, that was a smart decision. Staying in the trade would not have made us more profit. In fact, we would have lost some. So how did we make that decision? Well, mainly because we did not detect any more unusual option activity in Robinhood stock until now. And so in this video, we will analyze this new unusual option activity to find out if this wealthy investor is bullish and buying the dip or bearish and selling into this crash. Because as we all know, the rich have more access to exclusive research and information, sometimes even leaked insider information, to make better financial decisions. This is why smart money always stays one step ahead before the rest of the market catches on. No wonder the rich keep getting richer. And so, to level the playing field, let's dive into our analysis to gain insights from the rich so that our subscribers and members can profit from this deep knowledge too. As we can see here on the options time and sales tape, the most unusual trade happened on March 28th at 14:11 or 2:11 p.m. at the 11-second mark for these May 2 options at the 51 strike calls. 10,000 contracts were being traded for a price of 101. And so we can calculate the total cost of this trade, the price of 1.01. Keep in mind that options are priced per share, so we need to multiply by 100 since each options contract represents 100 shares of stock. And so each contract or trade costs $101. And since there was a quantity of 10,000 contracts, we multiply that out and we get a total of $1 million for this trade. But keep in mind, this is a higher risk trade in comparison to the trades that we share on our website. And so if you want to get access to the lower risk and higher probability of profit trades, then go to our website. We'll put a link to our website up here where you can get deep insights into exactly when and which stocks wealthy investors are trading on Wall Street so that you can have the same opportunities as the rich. Because if the rich get richer, why shouldn't you? Now, with that said, even though this is higher risk, we still traded this, but we use position sizing to manage our risk. As you can see here on the option chain for the May 2 options at the 51 strike calls, since this was a new opening trade, we also traded these call options and got into the same position here. POS stands for our position, and the green color means a buy position. Now, how do we know these were new opening trades? Well, notice that these options have an open interest of 125 contracts, which is much less than the 10,000 contracts being traded. It would not be possible to close out 10,000 contracts if there were only 125 open contracts. And so we can conclude that this wealthy investor was opening new contracts and not closing out contracts. This data is very important to figure out because if a wealthy investor is closing out contracts or trades, it could mean they're worried about that stock. So maybe it's not the right time for us to jump in. On the flip side, if a wealthy investor is opening contracts, like in this case, it could signal an opportunity for us to start a new trade. And so we always take this extra step to analyze the data at a deeper level because many other websites and scanners don't. They report all high volume unusual trades without filtering out closing trades, which leads to wrong results and losses for those following unusual option activity. And that is why we have more winning trades than other websites. Now, with that being said, not every trade will be a winner, but as long as we diversify our portfolio with high quality stock picks backed by strong data analysis and use option strategies that can gain more than what we could lose, then we can stay consistently profitable over the long run. And so, if you want more trades from wealthy investors to diversify your portfolio, go to our website. We'll put a link up here where you can get access to more opportunities and strategies to increase your profit potential. Now, back to this trade, let's break down the data even further. Based on our deep research and analysis of multiple variables and other data sets, this wealthy investor bought these 51 strike calls for 101 each, the same price as we calculated and saw earlier on the options time and sales tape. And so when we analyze this trade, you can see here on the risk profile profit loss graph where the x-axis represents the share price of the stock, which is currently trading over here, and the y-axis represents the amount of profit or loss. Note the zero break-even line here. And so when the purple line, which represents the current date, and the blue line, which represents the option's expiration date, are trading below this zero break-even line, as the share price goes down, this trade becomes more negative loss. And if it trades above it as the share price goes up, this trade becomes more positive profitable because this is a long bullish trade. And we can confirm it here on the Greeks. We have a positive delta trade. If it was a short bearish trade, it would be a negative delta. But be aware of the risk of this trade. We have a negative theta, which means that this trade loses value over time due to time decay. And that is why you can see here the purple line drops down lower to the blue line as we approach the option's expiration date. Since these options lose value through time, the break even on this trade moves higher as time goes on. And so you can see here, even though these call options have a strike price of $51, the stock needs to trade above $52 per share for this trade to be profitable at expiration. Because of this added risk, along with other factors, we only took a small position in this trade. We don't invest a lot of capital into these higher risk trades. Instead, we focus most of our capital on lower risk, higher probability of profit trades, the kind of trades we share on our website. We'll put a link to our website here. And if you missed our previous video on Robinhood, we'll also link it here so you can see exactly how we made 500% profit. Let us know in the comments, are you bullish or bearish on Robinhood stock right now? As always, please like, subscribe, and until next time, let's keep tracking the trades of the rich so everyday investors can profit too. Take care and have a wonderful day.